Broadly, let me rattle off a few points about Powell's speech. I actually even have notes, which is more important, so I'm pulling them up. I think it was frankly superb, not just because I agree with a lot of it, but in terms of how he did it and what he chose not to include. So there were three really important framing points before you get to substance. First was they made sure that the FOMC had voted unanimously for the change in the statement or the new statement before he even started speaking. And that is just reflective of how the whole process has been about slow consensus building by Powell, by Clarida, by the whole group. And I think that was incredibly well done. Second, he very carefully framed it as entirely about the medium to long term, so he took away from any of this, is it going to be effective in the short term? Is it going to raise inflation expectations today, tomorrow, the next day? Which again, I think was absolutely right. If he had tried to do it as a tool for raising inflation expectations in the here and now, everyone would have been disappointed, and rightly so. And thirdly, I think he really, in terms of framing, did a great job of stressing that this is a reaction to the changing economy. It was not a change in the goals of the Fed, although in fact it was a little bit, and it was not a change in the political situation, and it was not even a reaction to COVID. It was about fundamental shifts in the economy. And so I think those three things, having the committee already signed on board, making it about the medium term and not even pretending it's about today, and focusing that this is generated because of the real economy changing and not because of current events. I think all of those were incredibly smart. So what does it all mean? I mean, all of you are well aware that that people are using terms like average inflation targeting. I guess Powell sort of used that. And the markets types have already fixated on this idea of a moderate overshoot when you've got inflation coming back up after an extended downturn. And I actually think that was not really the point of the talk. To me, I think the big takeaways are first and foremost that this was as much about the process as about the outcome. That Powell started 18 months ago, Clarida did great work. There was the conference at Fed Chicago a year ago with Charlie Evans and everybody, the Fed Listens logo, and incredible amounts of work with Congress, by the way. So what we have is that the Fed has more political support and popularity right now than it's had at any time probably since the height of the Greenspan era in the late 90s. And this is paid off in that they've done all kinds of things in response to the crisis, including the international swap lines, including making emergency moves in assets that they would have found very controversial, or rather the Congress would have found very controversial any time before this. And, partly that's due to COVID. And there are always going to be conspiracy theorists and people who hate the Fed. But the bottom line is that Powell and the whole FOMC has done a great job of getting buy-in from the parts of the public that care and from Congress. And this is all about a tone of giving them, we'd say in German, Spielraum, of giving them latitude to be trusted to do what they do. And when you think that literally a year ago on this date, roughly, we were in Jackson Hole and I was there looking at Jay Powell, talking briefly with him after he had been shocked by President Trump calling him an enemy on Twitter. And they've ridden that out and now they're in this place. So I think that sense of political legitimacy for the Fed, which translates into credibility and flexibility, is the biggest accomplishment of this process, and frankly, I think was the real motivation. The second thing is, from an economic point of view, it's an incredibly pragmatic approach. It goes back 2 years ago, Jay Powell gave the speech in which he talked about R star and U star, the unmeasurable, not directly observable neutral rate of interest and the still very difficult to estimate natural rate of unemployment. And that we shouldn't be overly guided by the stars in a regimented way. And 2 years later, we're seeing the fruition of that. And Vice Chair Clarida, who gave his first speech as vice chair at Peterson a couple of years ago, or 2 years ago, September, I guess, had also hinted in that direction. And we're going to hear more from Clarida on Monday at virtually Peterson, we're proud to say. But I mean, in the end, this is a move away from fancy rules. It's a move away from abstract concepts. And I think this is absolutely justified. It's something I and many others have been pushing for a long time. Now, it's not all perfect because what Jay Powell is rightly doing is essentially admitting they were mistaken to start raising rates in 2015 and keep leaning towards raising rates in 2018, that they were leaving employment gains, potential employment gains on the table throughout that period. And that's true. In 2014, as early as 2014, Danny Blanchflower and I, among others, were writing about the fact that unemployment rate was an insufficient measure of what the amount of labor slack was, that you had to focus on labor force participation, that more people could come back into the workforce, and therefore the inflation pressures from low measured unemployment were not going to be there. There were also issues that you can't do much with macroeconomic policy, with monetary policy, when there is no appetite for investment. And so it's very important that Powell listed off that the trend rate of growth was down. The reasons for that are mostly in the real economy, not the monetary or credit side. But these were mistakes, frankly, that the Fed should have been fixing earlier, but now they've done it. And that is a very positive move. Two other points, and then let's talk and open up to your questions or comments. I think there were two things that he omitted mentioning, and one was this idea of rules, and he stayed away from that, which was great. But even more importantly, he didn't talk about forward guidance. And my fear, and the fear of I think a lot of people, fear is a little overstated, but our worry was that the Fed's framework review would be touted as this form of forward guidance that was going to move the interest rates up, move inflation expectations up, be a substitute for actual policy actions, or that future commitments to being loose when the unemployment rate got low would have effects on markets today. Well, we've seen this. So we've seen a few bips up in the long bond interest rates in the 10-year and the 30-year for the US Treasuries. These are maybe big for intraday moves, but these are very small compared to the amount those interest rates have declined over the last year or even over the last few months. And I think it was very wise of Powell not to be talking forward guidance in this speech. Now, I fear overstates. I am concerned that the committee is going to insist on making some noise about forward guidance at the upcoming FOMC meeting in September, and that will be just as useless as forward guidance has always been. But in a sense, this proves the legitimacy of the economic approach, that you could do something that putatively, in theory, was going to unleash higher inflation expectations and forward-looking markets would jump and central bank credibility would be imperiled. And none of that has happened, which essentially proves the point. Why don't I stop there? I hope that was useful to people in giving you some more context and analysis of where the speech is. But obviously, that's just my opinion. I'm happy to take factual questions or economic questions beyond my own characterizations.